For today's Business Brief, we're joined by Chief Market Strategist at InvestSmart, Evan Lucas. Evan, great to see you. The ongoing trade dramas between China and the US continue, and China threatening to retaliate in full if Trump does deliver on his latest threats on tariffs.
Yeah, he does. Good morning, Kieran. Good morning, Laura. I think what you've been seeing over not just what happened in the last 24 hours, and as you showed on screen before, with what's happened in Asian markets, particularly around this, the pressure is there. You are also hearing, varying views about who is seeing what and how. So the one that we've been watching very closely, you have to watch Robert Lighthizer. He is very much looking at it from the point of view that is going to happen on Friday. So you need to remember that would mean that not only the $200 billion of tariffs that are already there going from 10 to 25%, you're also adding the remaining amount of Chinese imports into the US, which is $325 billion US dollars. So that's $525 billion in total, would have a 25% tariff. It is why it's such a negative. You also showed on the previous screen the Aussie dollar. It has fallen very hard over this because, as you said, the Chinese retaliation is core to this. It goes core to his also political sphere. So if they were to do what they did last year, which was put tariffs on US soybeans, US wheat and US grain as a core, that is where the pressure is felt. And that, therefore, promotes the idea that this can actually get even worse and even more of a tit for tat. So far, listening to the Chinese delegation anyway, they still believe something will get done. And obviously this morning, Trump himself has said that's the case. But this is an incredibly hard ball. It's certainly outside the book of what you would normally expect in terms of these negotiations. And it's why markets are so nervous about it.
Yeah, Evan, on the markets, is this the biggest market mover at the moment? And it seems investors are genuinely jittery about this. Is there just no certainty at all?
There isn't any certainty, Laura, but that's in answer to your question, no, but I'll come back to that in a minute. I mean, the other thing that has happened probably since January this year with regards to the US-China trade issue is that we moved into a really constructive phase. So not just Robert Lighthizer, who I alluded to before, but Steve Mnuchin is the sort of the moderate voice, inverted commas, because he isn't necessarily that moderate, but he had been showing signs that there was correct steps moving forward, the president as well. I mean, make no mistake, if the president can go to the 2020 election with a deal in his back pocket, saying very clearly that he managed to actually move the People's Republic of China to his will, to actually see them actually move in their interest. Now, you can debate that to the cows come home. That's not the point. He has an unbelievable win. He has incumbency on his side and then this deal. So that's what he wants. Markets are moving on this because it has affected trade. We know the decline in Chinese imports and exports. That came out yesterday, significantly lower than expected, and has been affected since August last year. You've also seen it on the US side as well. There has been impacts. The biggest mover, though, Laurie, is actually at the moment around markets, particularly equities, feeling like they can get more free money. Central banks across the globe are being fingered for further interest rate cuts or some form of quantitative easing like we saw in the post-GFC world. What has happened, particularly in the last week, is that you are now seeing that's not necessarily the case. So the US Federal Reserve is certainly saying that they're not going to do it. Our RBA, the only one that was expected to move was the one that moved yesterday, and that was the Bank of New Zealand, and they did cut rates, but they had probably gone a little bit too hard. And that whole principle of free money was probably the reason why most markets globally had exploded this year. The US was up almost 20% till the top of April.
And Evan Lucas, just finally, I want to bring the focus back to home. We've got the election looming, so I guess a bit of uncertainty there in terms of people's approach to investment, property, all the markets. And then the RBA, I'm interested in your view there in terms of the employment prospects in this country versus the political view of employment.
Yeah, and that's the great question, Kieran, because what we were told on Tuesday is that the RBA now has placed a huge emphasis on employment, the unemployment rate particularly, and therefore also wage growth. And that in itself is certainly the political argument at the moment. If you listen to, depending on which side you follow, that the employment market is very, very strong. And that's true. We have seen in the last 2.5 years an employment boom. The issue that hasn't happened, and this is where the other side of the argument coming from the opposition, is that it hasn't come through into wages. And this is where the RBA sits, is that they are very aware that unemployment is moving to probably into maybe even 4.5% by the end of the year, but wages aren't coming with it. And if that doesn't change, they will be forced to probably cut rates because it won't flow through to interest rates. Sorry, it won't flow through to inflation. And this is the push-pull. But It has been a long, long time since the RBA has really put employment on the front foot rather than inflation.